Good afternoon, ladies and gentlemen. Welcome to what I like to call the heavyweights of multifamily. There are no middleweights on this panel. Everybody here is either Tyson Fury or the guy he beat up. We are talking only in the billions and billions right now. There are no small deals. The pedigree here is world class. Before I start to introduce this fantastic panel, let me thank Hershey and Stephen on what is so far an unbelievable job. This is a fantastic conference. I didn't attend the first year, and I got 400 calls from Stephen of why am I not here. This time I got about 600 calls, and I'm very, very glad I'm here. It's so far world class. So this is in no particular order of magnitude. This is just on the panel. We're going to start with Jordan Slone, the owner, founder of Harbor Group International, $16.3 billion in assets. I think we'll be at $17 billion very soon. We have a deal closing, I believe, at the end of this month that will take us over $17 billion. 53,000 multifamily units, 4.4 million square feet.
I like the way you refer to it as us.
4.4 million square feet of commercial space. In the last 5 years, you've acquired over three $1 billion portfolios. I know about one in particular. You also have a debt platform, which Harbor Group, which is doing a fantastic job doing whole loans, mezz and pref, run by who gave you that idea, Jacob? Thank you very much. And you also are the second largest buyer of Freddie B pieces. So a fantastic resume. Thank you very much for joining us. We look forward to a great conversation. Laurent, Morali, you recently got elected to be the president of Kushner. This was not a fought election. This was a good CEO, not president. Somebody else was running for president.
That's right. That's right. That's right.
So this wasn't a contested election, Okay, Laurent Morali from Kushner, $17 billion assets. I told you, just crazy, crazy numbers. Trying to make it $18 billion, over 19,000 units multifamily currently, 9.5 million square feet of commercial space. In 2021, you bought 8,000 units and sold 6,000 units, and you also do have a debt platform that does a lot of debt for development. Jeffrey Goldberg, thank you for joining us. Sold your company to Starwood for $4 billion. Now you are pretty unique on this panel because you are not straight out buying multifamily. You are deploying a $750 million discretionary fund. You look for unique opportunities. You won't buy marketed deals, but you ran one of the top 25 performing discretionary vehicles over the last 20 years. You founded Milestone REIT, which you sold for $4 billion in 2017. Thank you very much for joining the panel. I'm going to leave you to last, Pat. Joe Lubeck. Joe, one of my favorites, American landmark and a lecturer based in South Florida, approximately $5 billion in assets, over 35,000 units. This year, you bought $1.6 billion and you sold $1 billion. Thank you very much for joining us. And then, Pat, I think the youngest on the panel, founded your company in 2004, didn't go to university, which applies to a lot of us over here in the Orthodox Jewish community. Does not stop you from being a success story. I think you've had a killer year. I think you've done total close to $6 billion in transactions. You bought $3.4 billion this year, sold $2.4 billion this year, raised over $3 billion in equity. So a round of applause for this fantastic panel. Thank you very much for joining us. I want to kick it off with, I just want to have a very frank and fun conversation here. I want to kind of inspire the new generation of young buyers who are coming up, like Cyclone and others, who are making a mark in the market. I want everyone over here to kind of spill your secrets. Feel free to be very combative with each other. Feel free to yell and shout. I've got no problem. I've been on best and final calls with all of you. None of you are that friendly. Okay. So this year's been a crazy year for multifamily. They rumored about $225 billion in annual sale volume. We know that there's $230 billion of dry powder. It's incredibly competitive. It's incredibly frothy. You guys have all bought a tremendous amount. What defines why you go after this property in particular? What makes you rise above? I know you've got very strong moral grounds of what you want to spend, what you don't want to spend, but I've seen you, and I'm going to start with you, John, when you want something, you don't let it go. So tell us, what makes you say, I need this property in my portfolio?
So first of all, I just want to say, Henry, this is just a great panel. I meeting Joe face-to-face for the first time, but I've known everybody else up here, and Jeff and I go way, way back, so really a great panel. But what we do is basically, I get a portfolio, I sell it to $1 billion portfolio. I sell it to Pat. He then sells it to Laurent. Laurent calls me up, sells it back to me. Then I call Joe, and I sell it to him. And that's how we get all these transactions done.
And that's very funny. In the game of musical chairs, Laurent, you were competing with Joe to buy a property in Jackson, Mississippi. Can we put up a map of Jackson? Can someone, Laurent, can you point me where Jackson, Mississippi is in America? Do you know where And I think it took you 3 planes to get there, unlike Jordan. You don't have your own plane. But we made Jordan fly to Jackson, and he was mightily pissed off when he didn't get it. So why did you want Jackson so badly and went head-to-head with him to get it? What made you want to buy that property?
You want to put the map?
I was just teasing about the map.
For the record, I know
because you Googled it beforehand.
I did.
Just to know where Jackson, Mississippi is. Okay, go ahead.
No, why Jackson? Because Jackson is just part of some of the markets we identified as having strong fundamentals. You know, we heard the panel this morning. I heard right before this brilliant presentation. So where is the growth today in the country? And it's the Sun Belt. So Jackson, state capital of Mississippi, has a lot of the fundamentals we were looking for, a lot of the boxes we wanted to check. Not very institutional yet, which means that the cap rates, in our opinion, were more exciting than in some of the more popular markets, such as the Atlantas of the world, which we tend to stay away from, and it just checks a lot of our boxes.
So you're looking for kind of diamonds in the rough, kind of going off the beaten path,
yes.
Because Jackson, I wouldn't call it one of the most popular Sunbelt states. It's kind of a little out there. So in this very contested market, you found something you went head to head, and you said, I'm going to pay $12 million more than, no, it wasn't $12 million, I'm kidding, more money than Jordan because I really want to be in Jackson more than anything in the world.
I think of it as a microplay, okay? So the microplay is Sunbelt. Now, a lot of people in this room are thinking the same thing, so everybody's focused on the Sunbelt, and everybody is bidding on the same deals. And it's easier to go to Atlanta, as we just talked about. You talked about how many flights it takes to go to Jackson, especially during COVID, I must say.
Especially without a PJ. Now in your new role, they should maybe upgrade you and get them with a plane.
And so, it's easier to go to Atlanta. It's easier to go to all the major gateway cities. It's harder to go there, but truthfully, you will benefit from the same trends. And I might argue that there may still be a few years behind where the leaders in those markets are, which in my opinion are too heated.
Can I go back to the question? I was joking around, but I did want to just say that I really think, and kind of goes to Jackson, is that we get together within our company several times during the year, strategize, and talk about where we think we can differentiate ourselves. And it just so happens, all jokes about Jackson, we decided we're going to look at some cities that most other people won't look at if we could get a big enough presence, and that was a nice portfolio. The properties were actually very nice. But so whether it's a big portfolio or a big single asset deal, if we feel that the competition is limited and it fits what our investor base, which is with institutional investors, family offices, et cetera, we will go hard after that. If it's a regular 300-unit deal in Atlanta, value-add deal, we'll let others chase it. And that's, to your question about advice to others, I think, we have all these low cap rates out there. The market is crazy in a lot of cases. You still, if you look hard enough and if you have a strategy, there's still things to do.
Pat, and this is between Pat and Joe's, you guys have been trading a lot between each other. So, Pat, you've put out a tremendous amount of money this year, and you bought from Joe, and I think you guys bought a few deals.
I bought from him.
And you bought it from each other. So the joke is not so far off. There is a little bit of trading between each other. So the question to you, Joe, and then we'll come to Pat. Joe, I've been on with you on best and final calls. It's like being with an incredibly aggressive man in a very small room. You're like pounding on the cellar. Let's just get the deal done right now. You want another $1 million hard money? Done. Just when you want something, you really go and get it. What defines something? What makes you want this property? In your mind, you've been in the business for many years. You've seen a ton of multifamily. What drives you to get this property in particular? That's what we want to know.
Well, for us, it's really been fundamentals, and it's been the same fundamentals for 25 years. I've never seen a market like this today, but I appreciate the discussion about Jackson. I had the same discussion with you New Yorkers 25 years ago when I said I wanted to buy in Jacksonville, and they said, is that in Georgia or Florida? It was not an unusual discussion to talk about that with Tampa, and why are you going there as opposed to Atlanta or Dallas? But the bottom line for us is, despite what I consider to be an overheated market today, I think we all see a lot of bidding. The reality is where we see opportunity, and for example, buying from Pat. He's a smart guy. I know he's done a great job. But, for example, the deals that we may be buying from him and vice versa might have been renovated 5 years ago, 6 years ago. And it's ready for a refresh. And it's ready for the latest and greatest. And there's some new amenities. Now it's stainless as opposed to black appliances, or a different set of parameters, smart locks and things of that nature. And so there's an added opportunity for us to go back to what he did a great job on 5 years ago, and vice versa. And it's a pleasure to be on the panel with these guys, because we have all traded back and forth amongst us, but we're also all friendly competitors. We also all want to do a good job. It's very difficult sometimes, and we get questioned by investors. They'll say, well, if you're buying from Goldberg, you're probably paying top dollar. And I've got to explain that, no, I still think there may be opportunity there. And that's really true amongst all of us.
They're right. They're right.
Yeah, you're making a bad decision buying from Jeff. Thank you, Joe. Pat, as I said earlier, you put out close to over $3 billion this year. So what have you've just gone out there and just splashed the cash and bought these loads of properties? What's been your thought process behind going and buying all these properties?
Kind of like Joe said. I mean, you have to pick, fundamentally where the people are moving, where the jobs are going. What you said about going up to New York, when I started doing this in 2010, I looked like a redneck in a pickup truck talking about Atlanta, Georgia, Texas, all this stuff. Now these markets are all in vogue. So it's identifying markets that you either own or operate in, that the wind's behind your back. And then it's, back to what Joe said, a lot of times, a guy like me will buy a deal, cap rates compress, and my equity partner says, let's sell. And we haven't finished the renovation or anything. So a lot of times you can buy from guys that know what they're doing, but they're selling with meat on the bone, So it's really finding something where you believe you can create value above whatever the market's going to do, but also identifying the right market.
So from what I hear from all of you, there's always opportunity out there. No matter, you guys are all seasoned vets in the business, you can constantly find value if you look hard enough. Jeffrey, you're pretty unique because unlike these guys, you're not bidding in the bid process. You're not looking at a lot of deals. You're looking for very unique opportunities. You're looking to deploy equity behind other people. So how do you go about your process of identifying what makes sense for your group?
So let me just differentiate a couple things. First, we're happy to bid on opportunities out there, but the difference is I don't have the ability to go after 20 different brokered deals and have the opportunity to win one. I mean, the math doesn't work, and there's a lot of overhead that we need to cover, so that's a bad equation for us. Pat and Joe are right. The truth is, most of us have to sell assets because of some, strategic reason. Pat gets a call from his capital partner that it's time to get out because we've realized our 5-year business plan, and so even though it's year 2 or 3, it's time to sell. Pat's going, there's still a ton of upside, and that's where Joe looks at it and says, we want to own it because we want to finish it. So because something's being sold doesn't mean that the lemon has been fully squeezed. For us, we've evolved, and the truth is, I used to look exactly like these guys. We were fully integrated, 60,000 units under management, 1,500 people managing it, and about 4 years ago, we sold our publicly traded REIT and our 1,500 unit property management company. And what that did for us is it allowed us to become more strategic with, quite frankly, folks like you guys, where I don't need to be bidding on every deal because I get a phone call that someone's got something tied up. We've got the capital to do it. We've done the property management, so I know exactly what the numbers should look like. And so our goal is to be a strategic partner. I mean, there's nothing worse than, and I grew up in New York where I was getting the crap beaten out of us by all the big boys, right? Where they have a 25-year-old telling me, that No, the CapEx shouldn't be that, or no, that we should be doing this. And it's a horrible existence. And so I really believe that there's got to be a sort of a better way of transacting. And so our goal is, we still want to do, lots of deals, but I'm not telling my partner, what they should and shouldn't be doing. Because I'm assuming that we're partnering with the best in class in a particular locale. And so they're smart guys, we're smart guys, and so it's all, collaborative and creative.
I want to talk about the fact, you spoke about selling, and Pat, I want to come back to you on selling. We sold a property for you recently, and again, I'm a bit new in the business, but I think even our peers said that was just ridiculous. The strike price was a 3-pack portfolio, 80s vintage. The strike price was $367 million. It was just crazy. The bid process went through the roof. It finally went over $400 million, and then the end buyers, who are a vertically integrated management company, literally begged you to give them the deal and said you can stay in and manage for 5 years, even though they have their own management company. So let's talk about selling. We've spoken about buying. Let's try and understand what propels you to sell. Pat, you've been on a selling spree. And again, we all know that you've got partners and sometimes you're forced to sell, but what tells you it's time for me to offload? Is it just that the market is so crazy right now and it's a great opportunity? What is the factor? What is your thinking when it comes to you selling? And you've been selling a good amount. You've been buying a good amount, but you've been selling a good amount. What determines why you sell something and when? Give us the insight into that decision making.
Yeah, I think initially it's aversion to risk. You watch this market run up. In 2019, I was selling a lot too. I thought this is run too long. So 2 years later, it's I don't know when it's going to end, but it's going to end. So it always feels good to sell, build up liquidity, things like that. So that's kind of, I think, drives our selling. Initially we started out kind of pruning the portfolio. We wanted to get rid of older assets and kind of upgrade the portfolio. But really, if we finish the business plan, if it's a 3 to 5 year hold, we're not looking to go and renovate the property again. It's generally a good time for us to exit. And then we target 2x on equity. So if we can run the numbers and hit our returns, it's always good giving capital back to investors.
And you said the GP is not bad either.
Yeah, the GP's not bad at all.
The GP is not bad either.
Oh no, I do it for the promote. Let's not, yeah, I like cash.
Who doesn't? Joe, for you as well, just is it the same thing as Pat? Is it just it's time, I'm out, I'm gone, let me sell, or is there? Because what I'm hearing here, it's not really. There's no clinical kind of thought process. It's really kind of you're just moving as the market moves and making decisions as the market turns. You're like, I'm here, I'm getting out of it. I'm moving into here, I'm going for this. So it's very much a businessman instinct, is it not? Is it about being an entrepreneur, seeing value, understanding when to move in and out of positions? Is that what it is?
Well, we are, frankly, somewhat clinical after 2 or 3 years. We look at every deal every quarter. I've been accused by a lot of our international investors of selling too soon, but I'll take that all day long. There's that famous old Rockefeller quote about, I never lost money taking a profit too soon. But at the end of the day, we're fine leaving some meat on the bone and not getting the last dollar. Of course, we sell at a reasonable profit. And yes, the GP promote is obviously critical. Mrs. Lubeck very much appreciates that. But the reality is, we look at the same metrics that Pat talked about. We want to make X IRR and we want to make 2+ multiple. And if we hit that number, we're likely to take the risk off the table. From a portfolio perspective, we're always looking at the constitution of the whole portfolio and what's in a given fund and making sure it's properly balanced by age, by geography, by a number of those things. And then, we'll depart early if need be. Obviously, right now, the market is fantastic. But we also, want to see the next buyer have an opportunity. And usually it's when it's ready for another renovation. We don't want to, renovate it twice. And as much as I would love to, we can't buy from ourselves because I would love to buy from Fund 2 and sell it to Fund 4. But that's obviously a no-no. So there is opportunity there. And, it's great to trade with the guys on this platform. And then I can say, all right, I sold you one. Now, come on.
I think what Joe mentioned about rebalancing the portfolio is important. We do it all the time as well. You get too overweight in Dallas or Atlanta or Orlando, and you rebalance. There might be a market that all of a sudden you see as a great growth market for the future, so you want to add exposure there. Those things are, I'm sure, that all of us take into consideration as well.
And Jordan, you were nodding away when Joe was talking, and I've heard this many times. I've heard that you can buy a harbor deal, and that you can still make money. So you guys do believe in leaving meat on the bone. You're not looking to squeeze every last dollar out. You're okay with moving on and saying somebody else can take it over.
Absolutely. That's, we had our business plan and let somebody else. There's still definitely meat on the bone.
I think the key here, I think that's what we're hearing here, is to always be nimble and listen to what's going on in the marketplace. Similar, to Joe, on a regular basis, we review the performance of our portfolios, and you compare to original underwriting. And there's a time, if you think that, having partners who call you and say, "Hey, I'd like to sell," is one thing. But beyond that, I think, like I said, being open-minded, being opportunistic, and realizing that, on this particular deal, we thought the value was going to be between 100 and 120 after 7 years. It's 150, maybe. You sell and you take your chips and you go somewhere else. Over the last 24 hours, I met people who bought properties from us the last 12 months, and I was happy to hear that they were happy because they also found some meat on the bone and they're doing their own thing.
But if I could just add one other thing,
sure.
We're all fiduciaries. We're all representing either pension funds, insurance companies, family offices, endowments, high net worth money, and so it's our obligation to make sure that we're taking chips off the table. Everybody, there's a lot of folks in this room who've only seen the market going up. Well, it doesn't just go up. And there's going to be some exogenous factor out there. All of us are saying, the fundamentals are so good, it's not going to stop. It's raining dollars. But I assure you, over the next 5 to 7 years, there is going to be something, and we're all going to be surprised by it because we didn't, foresee it. And it's important to make sure that our investors get capital back, make sure that we're doing the right thing. Even though we think there's still upside, you need to make sure at the end they need to be able to pay their pension years.
So being nimble this is kind of like a side question to that question, would mean that you want tremendous flexibility. So that would mean the debt that you're putting on should all be floating rate, easy to exit debt, no long-term fixed rate debt, because that doesn't give you the ability to move in and out products because you're going to have high yield maintenance. I know we were talking about that before, Joe. Wouldn't that make the most sense on nearly everything?
No,
but we just did a deal where we put on 7-year fixed rate debt.
Exactly.
Yeah.
We've done many big, huge portfolios over $1 billion where we don't plan to sell most of the portfolio for 7 to 10 years.
But how can you know? You say you're reevaluating portfolio all the time. You're too heavy.
First of all, you have to listen to your partners, as has already been mentioned, and you have to have a business plan. It's so important to have a business plan. Sometimes you reach your business plan early, and
then you'll saddle with that long-term debt.
No, but your business plan has to be, again, you have to listen to your partners. You have to, I always tell people, if you have $1 and tomorrow somebody pays you back $1.10, that's a very nice IRR, but you didn't make any money. So you have to keep the properties for, in some cases, we bought the Sunbelt portfolio, for example. Those markets are hot. They're going to stay hot, I think, for the next several years. We sold off a few properties, but the bulk of the portfolio we plan on keeping for the long term.
Okay, I think, if I may, just because I think that's where you were going, Henry, the trick right now is that by doing what we're doing, which is constantly looking at the performance of your properties, things have accelerated, the last 12 months, 18 months, 24 months. So what does it mean? It means that suddenly you're in year 2 of your deal, but you're in year 7 of your underwriting.
Because rent growth has just exploded.
Exactly. So then comes your question. So then what do you do with it?
Yeah. And by the way, I'm sorry, but if I could just add, anybody who puts only floating rate debt on their whole portfolio, in my opinion, is asking for trouble.
Absolutely.
So just to add to that briefly, we also want to look at the balance of our debt.
Exactly.
And we look at the expirations.
Just like you look at the allocation of
Absolutely.
where your properties are, you look at your total debt on your whole company and where the properties are, and you don't want to be exposed to interest rate risk.
Right. You want to have the worst thing balance.
The worst thing that can happen is you'll have more cash flow.
Right. But
exactly.
But Joe, we were talking earlier, in the beginning you did a ton of fixed rate debt and you've sold a lot, which has sometimes hurt you a little bit having to pay that yield maintenance, and now we've kind of moved over to the shorter term debt because your window has compressed over the years to a 3-year window. right? So has that been a factor of the market that the market is just so on fire and it's so great to move in and out positions? Has that been the determining factor of why you've changed your mahalach? There you go, Hebrew word. Your way.
So we're still doing some of both, although we are moving more towards floating. But then there's also some opportunities to adjust those and convert. But the bottom line, a few years ago, 5 years ago, 6 years ago, we thought that high 3s and 4 would be a wonderful bet and we'd be in the money on all of those fixed rates. And I went the wrong way, but I would probably make the same choice again.
It's funny to hear Joe say that because we're actually moving more toward fixed rate debt on most of our properties. We're at historic lows. I mean, a lot of people in this room don't really know that. I mean, Jeff, I remember when we came into the business, interest rates at that time were, 7% or more. And so when you can lock in fixed rate debt, 3, 2.8, 2.9, 3.1, I mean, it's a great opportunity.
And so just to put it in perspective, we have watched the market over the last 15 years where all our competition is floating. We have fixed everything. And so at some point I'm going to be right, but our theory is that we're telling our investors what we believe we can generate in certainty, and I'm not betting the markets. So we've been ultra conservative.
But Jordan is correct. I mean, I remember, and I think I'm the old dog here, but we used to actually have a sign in our war room that said 8 is great and 7 is heaven. And we made money doing that in value add at that time. We're talking early 90s. So what we have today clearly is heaven. Whether this time we'll be right with those bets, I suspect we will. But we want to have a nice balance. And it also depends on the vintage of the asset and how long our hold time is with that particular fund.
Sorry, if I could just add one more thing, Henry. Again, there is definitely a place. I don't want anybody to misunderstand me. There's definitely a place for floating rate debt, and bridge debt. You buy a property, you're going to reposition it, you're going to do something major to it. Maybe it's got a big vacancy. That's a place where you don't want to lock yourself in because you're going to create a lot of value.
It matches the business plan.
It matches the business plan. So. That I think that is there is definitely a place for floating rate debt, just like in a bridge program, like Harbor Group's bridge program with floating rate debt.
Free plug for Harbor Group's bridge program, ladies and gentlemen. Yeah, and I think that's very important to kind of look at the property, understand your business plan. But as a lender, and just a shameless plug for Newmark, we'll do about $40 billion of multifamily sales and $20 billion of multifamily finance. We've seen a very big shift in our borrowers who've typically always been Freddie Fannie borrowers who are now looking kind of outside the Freddie Fannie world and saying, look, I like this bridge from KKR. And before that, Jordan, with you as well, you would never have taken a 3+1 deal. Pat, you were all Freddie Fannie from day one. Joe, you as well. But you guys have kind of embraced this change, embraced all the different debt fund lenders out there that can give you what you want. If you're doing a big heavy play, we did a big loan with an $18 million capex play. You guys went for that. So let's talk about the new alternative lender that's in the space right now and how you utilize those guys for what you want to do more than just the business plan. Is it just the business plan that makes you determine, or do you kind of want to spread out all your debt across different platforms, not be just so tied to one lender like it was back in the day?
So first of all, there's a huge difference in the let's say before COVID hit, and even when COVID hit, the spread between, let's say, a debt fund execution and the agency execution was probably 150 basis points, if not more. And today, it's more or less the same. Correct. It's more or less the same. So it's really, things have changed a lot.
Pat, go ahead.
Yeah, the debt funds are a phenom right now. I mean, you have to kind of be in business, with them to get the proceeds, with these cap rates. So they're more willing to look at future, rents and kind of pro forma out, and they've made the right bet. Freddie and Fannie are kind of missing the boat. We love doing business with them. We just did a Freddie execution, but it was a lower leverage deal. So I think as you have to, compete in this market and believe in the future, rent growth, you really need to line up with those debt funds. There's just so many of them. We're trying to pick a handful of them and do a ton of business with just 3. But yeah, you kind of have to play with them right now.
And they could be around for a while, these debt funds. I can't see Blackstone, KKR, Ares anytime soon exiting this picture. So you've got this glut of fantastic cheap debt that will go super high leverage. And what are they saying? They're saying cap rates be damned. I'm just going to underwrite to your business plan. Do you think it's their entrepreneurial spirit, their understanding of the business that's helping them underwrite, while Freddie and Fannie, big, huge government institutions who are stuck with the DSCR? And is that what you think it is?
It's a little of that. It's a little. They have so much capital to put out, and they're going to put it out. These guys are business people. They're getting paid a lot more than the agencies, and they're motivated to put that capital to work. So I think look, the Blackstones of the world, KKRs, they're making a bet. They see the market. They feel comfortable kind of lending on forward-looking rents. The agencies don't really need to take that risk. They're fine. They'll always be there. But yeah, the debt funds are equally as aggressive as buyers these days.
And many of them are buyers. Blackstone has a huge portfolio. Brookfield has a huge portfolio. So they are, many times you're bidding against the guys you'll ultimately take debt from. It's very bizarre. Laurent, you wanted to add something?
No, I was just going to say, I remember a couple of years ago, and I think the debt fund, but also the CMBS lenders were really the other alternative for a lot of markets where the agencies were not lending aggressively or not lending at all. The CMBS lenders are still here, but I don't find them as active as they used to, or as aggressive, I would say. And but the debt funds have definitely stepped in. Yeah.
I want to add something. I also think it's important. I mean, we've talked about how the debt funds have come on strong, but Fannie and Freddie are good lenders. Their default rate,
amazing,
over decades is really terrific, and I think that's something that, as I've gone through my career, that I've appreciated. And those of you who do business with Harbor Group, that I appreciate the input. So having a value add lender, including Freddie and Fannie, if Fannie and Freddie don't want to do something, you should take a second look and make sure that there's not something that you're missing.
Yeah, absolutely.
But it's important to have relationships that also add value, not just they're going to give you an extra 5 basis points off.
Jeffrey, you said something that kind of resonates with me, and I think with Pat as well. We've just seen this tremendous trajectory of values and activity, and we've not seen a down market. And 5-6 years ago when I entered the business, I heard this phrase all the time: we're in the 11th inning. We're in the 11th inning, and I know nothing about baseball. So that thing was me. We're at the end, and this is 6 years ago. 6 years later, we are going strong. And if COVID has done anything, it's only helped the multifamily space. We've seen a new generation of tenant, the single-family home business. Joe, you've been buying single-family homes like Blackstone, which is crazy. The single-family home rental business has emerged, meaning older people who've lived in their home, who bought their home for $200,000, now their home is worth $600,000, are now selling their home, moving into apartments. We know those tenants are much stickier. You said, Pat, you carry them out in a box when they go. They kind of don't leave like younger tenants. So how do you see the future going? You've got this kind of, you're saying that it's going to end at some point, but how do you see it? Why do you think so when we're so on this crazy growth rate? Maybe we can't keep on going all the way, but where do you see the dip?
Yeah, look, we're always looking at the positives, and then something happens, right? In most cases, a lot of us don't see the ultimate catalyst that occurs, and then in retrospect we'll say, oh, we could have seen it, we should have foreseen it. But the truth is, right now the fundamentals are terrific. I mean, Joe is absolutely right. Where whether it's growth, supply, in so many of the markets that we're in, and we're predominantly in the Sun Belt. We've never seen this kind of positive activity. Now, all that said, to your point, we match all our financing to the plan, to the actual business plan, so that if we actually are able to, and we're blessed to, deliver it early, you know what, we'll sell the property either free and clear or yield maintenance, but we're all making profit, and that's okay. My concern is, we're talking about like the debt funds, let's face it, they're an accelerant to what we're seeing here. They're feeding into, what's that? You need 75, 80% LTV. It all is good until the party stops.
Yeah, I think Warren Buffett said about market cycles. It's like sex. It always feels the best right before it's over, you know? And so, you know, it's
Very true. Warren Buffett, he knows. He's a handsome man. Joe, let's talk about the single-family home business, because this kind of leads into the next question, and I want to get all your take on this. Today, the hot sector is value-add multifamily. That is the hot sector. Everybody wants to buy value-add multifamily. If I had a nickel for every time I had a borrower say to me, we're going to change the kitchen cabinets, put in new appliances, and then we're going to bump the rent $300, and it's done, I would be a richer man. Anyway, so tell us where you think the next big trend is going. You've been buying single family. Do you think the single family home is the next big trend? Do you think new built multi? What do you think is the next big hot sector in the multifamily world?
Well, frankly, I think right now everything is overheated. And I'm waiting for the last shoe to drop, or waiting for the end of the adventure, shall we say, that Pat refers to. That said, we are cautiously proceeding in the single family world. For us, again, in shape of the portfolio, we shaped our portfolio very specifically, not only to be diverse geographically, but to be 95% ones and two bedroom. And so we looked at who we're losing. And we said, this is a logical continuum for us to buy brand new. I don't want to be in the renovation business on scattered site homes. I'll let other people figure that out. Blackstone is far smarter than I am, and I don't think they've figured it out yet either, despite their great profits, or any of the other big publicly traded. But we said we'd buy brand new homes where we don't need to do renovation in the same geographic areas where we've got apartments, and we'll work on a seamless transition for people who want the 3 and 4 bedrooms. And we've bought a couple thousand homes so far, and so far it's going great.
That's incredibly smart. That's
but,
great, because you're moving your tenants from your
apartments. We see it as that we'll offer them appropriate relocation with no new application, no new deposit, all of those things to make it seamless. So that's a little bit of our thinking there. We don't want to go head-to-head on what I'll call used homes. We don't want to be in the renovation business in scattered site. It's hard enough to do 300 renovations in one location.
Joe, I'm just curious, were the homes built for rent? They were conceived to be rental from the very beginning?
So we're getting a real mix. Frankly, what we're buying is middle of the road, what here in the South people would consider starter homes. You know, when I grew up, my first house was, I think the first one I bought was $79,000. Now a starter home is $279,000, and you're not getting much. But a lot of these, through some of the relationships that we have and with other partners, we've been able to access a pretty nice pipeline. And now we're also venturing into that build space where we're partnering with builders, helping to accelerate them because they're lacking the capital they need to build in the proper volume. Obviously not the big publicly traded guys, all of whom now have gone into the business themselves. Yep. So there's no reason to compete with them. But the small to mid-sized builders need the equity. We have the equity, and we're partnering with them. So I think it's going to proceed. Laurent and I were talking earlier about, when is the music going to stop? And I say, well, it has to. I've been through a lot of cycles at this point. Fortunately, we've always been low leverage, so we never had a real issue and used it as a time to buy. Frankly, I hope there is a cycle, because with dry powder, that's a great time to buy. But when I am asked, what do we think will be the catalyst for this? I really don't see one today. I'm sure it's out there somewhere, and I just haven't identified it yet. But it's going to come. It has to come. It will come.
Yeah, I remember when COVID hit, I was sitting up in New York, and literally we were having calls with our lenders, and they were talking about sending out forbearance and everything like that. I thought everybody was going to stop paying rent, and we were all screwed, and it the opposite happened, thank God. But,
They paid more rent.
Right.
They said, I want to live in a nicer place. I got to sit from home. Let me go upgrade my apartment. So it just was a boon to you guys.
But it really was. They were sending out letters, CBRE, our other debt brokers were saying, look, here's the process for basically giving back properties. And that wasn't that long ago,
So Henry, back to your question about the future, so sort of bring it full circle, COVID really did, push a direction, but pushed it much faster, right? So the Sun Belt states, gained in population, gained in popularity. People looked at the tax benefits. People looking at the quality of life, life-friendly versus, more restrictive. And so I think that has shown a light on the Sun Belt versus, I think, some of the, the gateway cities, and I think that'll only continue, unless and until,
I'm
again, that
not sure
exogenous.
I agree with that, Jeff.
Yeah.
I'm
So
not
Jeff,
sure.
just to clarify, Jeff is saying that he sees the future that the hot sector will continue to be in the Sun Belt regions because the gateway cities have suffered. San Francisco, Los Angeles, New York have suffered. So you think more money will pour into this hot part of the world?
I think it will continue, and I'm not calling the death knell on New York at all. But I think that I don't think that the concept of folks saying I can do what I did in New York elsewhere is going to end the day that Goldman Sachs gets all their employees back in the office.
And Jordan, why don't you agree with that?
I just think that you find that things cycle, and there's also some resetting of rents. I mean, New York went through a tough time. San Francisco's going through a tough time. And there's a resetting of rents. I mean, I could tell you, I know young people that when they heard that in New York they could get 3 months free rent, they went for it. Yeah. So, and as somebody else told me, there's no Broadway down here in Miami. There's no New York Yankees down here in Miami. And this is not just about New York. I mean, again, I think whether it's San Francisco.
We have the Dolphins. Are you kidding?
But so I think there's I don't think all of a sudden everybody's moving to the Sun Belt permanently. Things ebb and flow, and
Okay,
I think
so
we'll continue
what
to
is
see that.
what do you think is the next hot sector coming in the future? What do you think is the place that you would want to park your money and buy
I
more?
actually know exactly the answer to that, Henry. But guess what?
You're not gonna tell
I'm
us.
not going to tell anybody because then there'll be 750 people chasing the stuff we want.
Thank you, Jordan. Thank you for being on the panel. Very helpful.
Henry,
Laurent, you're
After we buy a few $1 billion
You'll tell
of
us.
it, then next year at eCore, I'll tell everybody
Right, fantastic.
what they should be doing.
Laurent, why don't you tell us what we should be doing next year?
no, what I was going to say is I think we're mixing two things, if I may. We're mixing where people are moving, and we're mixing where institutional money wants to invest. These are two separate things. Okay, and there's always a delay in between these two things. So, and I see it every day. The money is constantly being recycled, right? So, a year ago, nobody wanted to touch urban areas. Nobody wanted to touch New York City, even Gold Coast, New Jersey. That's a year ago. A year ago, nobody wanted to touch development. Okay, and now suddenly, people who didn't want to do development last year, who are big multifamily players, starts going into development. Because, why? Because that's where you get the yield, right? And I believe that you're going to see actually a reversal of fortune for the urban areas and for New York City in particular. So when I say New York City, understand New York Metro, right? Because New York City proper has some issues with the rent regulations, etc. But you can bet on New York City without being in New York City proper, obviously.
Right, but they're inextricably linked, right? And it's not that complicated. We follow population growth, right? And so where the people go is where the money wants to be. And the reason the money didn't want to be in New York is because the people were moving out of New York. So there's no surprise there. People are coming back to New York, and so the money's going, okay, I think I get more comfortable. But I think my whole point is that the Sun Belt is not a phenomenon that is disappearing. And so I think that will continue. I'm not saying that New York, won't, start to revive itself, but I do think that a market like San Francisco has got to think about the value proposition, right? You have the opportunity to pay, the highest rents in the country in San Francisco, or potentially do that same job in another market, like in Austin, like a Boise. And I think there's a lot of folks that are saying,
Boise?
I'm not sure, believe it or not, Boise is one of the hottest markets.
Yeah.
No, but we can compare, in my opinion, San Francisco and New York City.
Why? They're very similar, both very awful political climates,
I know,
tons of
but
homeless,
exactly.
shooting up heroin on the streets.
The main difference is that San Francisco relies heavily on one industry, which industry has been, headlining. Everybody can work from home. So that obviously has an impact on San Francisco and the appetite that you or I could have for San Francisco. I love the city, but right now I would not want to invest there. However, I think New York City is a lot more diverse and has a lot more to offer. And we discussed earlier on the panel, look at what Google is doing, Facebook, Apple taking more space, etc., which really shows that these companies, they know exactly where to find the talent.
Exactly.
And I think that ultimately that's what drives
As soon as they make
people.
their employees go into the office, right? Where they're taking,
But
they're taking
why-
space. And
I
it's-
don't
No,
want to go
no,
into
I
an office
understand,
talk.
but-
We spent an hour on the office talk earlier. let's stay away from the office talk. Joe, you wanted to add something?
Well, I was just going to add a comment that we try to be sub-market specific rather than just general market specific. So, for example, you look at what are considered two of the hottest markets in the country today, Austin and Nashville. But they're very specific sub-markets, and that's true of every market. So we like to try and, I tell the team, stick with what we know, and they may sound corny, but we don't do a lot of exploratory research with the money that we're entrusted with. As far as the next hot thing or whatever it is. Obviously, we've always been a believer in the Sun Belt. We've been here for 30 years. We think we have very discrete and very specific boots on the ground knowledge in all the markets and sub-markets we're in, and we think that's really critical. I have a very close friend who, along with one of our big equity partners that we have in common, has been focused on Indianapolis, Columbus, and Kansas City, and they're doing fantastic. They said, do I want to join? And I said, well, no, I really don't. Not part of our business plan. And I'll look as stupid in Kansas City as the guy from Kansas City does when he comes to Tampa. And we just don't want to join that club. So I encourage people to pick a focus and get sub-market knowledge, not just market knowledge.
I like that. This is a real kind of true-to-life question to really kind of get your expertise. Everyone here, besides Jeffrey, is vertically integrated. Management is a huge part in your business. Patrick, I know management is kind of your bread and butter. It's where you cut your teeth. It's where you've made your money. You run fantastic. You guys manage 50,000 units. Kushner, you guys, you all manage your apartment buildings. What do you do operationally to drive revenue, to retain tenants, to build a brand, build a reputation? I think there's a company that online company that makes the community within your buildings, and that has shown to retain tenants by 30%. What are you doing different in your management company that makes you stick out from your competitors? John, you want to take this first?
Yeah, I mean, first of all, I have to confess that this is a better question for our president of our management company. But I will, who's been at Harbor Group for 30 years and does an amazing, amazing job. So, I mean, first of all, for a company like ours, I think it's consistency. Consistency is so important across the whole platform. I know a week ago I went to Dallas. I went to our properties there. From property to property, people there's just a consistency to look at the property. Technology is another thing. Technology, we learned from COVID that it changed everything. If you, Harbor Group also has a hedge fund that invests in real estate, only publicly traded securities. We listen to the earnings calls. You listen to some of United Dominion and Camden, Avalon Bay. They have less employees on site today than they did pre-COVID. They learned that they could operate the properties using technology.
Who's
and
fixing
doing
the
things
toilets?
differently. Excuse me?
Who's fixing the toilets?
You have YouTube fix-it-yourself videos. It's not a joke.
Send me a work order when it's done.
Not a joke. During COVID, at our properties, we did YouTube.
No way.
Yes, we did. Do it yourself. Change your air conditioning filters. We dropped the air conditioning filter at the front door and went to send them an email on where to go, how to change the filter. They didn't want us coming in, and we didn't have to send our maintenance people. So I think, again, you have to be completely proactive. But again, I'm not necessarily the best person to answer that question in detail.
Pat, talk about it. Talk us through this, because management is a huge part of your business. What are you doing at your Carroll communities that's pushing revenue, keeping tenants? Tell us your secret sauce.
Yeah, I think it's keeping motivated employee base, which is harder now probably than ever. But we try to pick the right people. We set our standards high. We say we want excellence. We don't want just good enough. I tell on-site managers, our equity partners can come buy these properties at any time. So I want everybody to look the part. I want the properties to look great. And then we don't micromanage. I mean, I certainly don't micromanage from the top of the company, but we really give them a lot of flexibility to make their communities their communities. So if it's a local Houston property, they're going to have a Texas, they're going to have a barbecue on Fridays or something to try to incorporate, you know, a sense of community at these properties. And we encourage that kind of thing. We do a good job, I think, branding the assets, branding the company. I think that all kind of, you know, gives a sense of ownership and a sense of pride. And I'll just fire them, you know, if they don't do the right job. So, you know, that's a motivator too, you know.
And pushing revenues, do you find that having that community, can you upcharge, can you push rents, or is that just a factor of the market? Or are there things that you can do on your properties that give you the ability? I know when we underwrite properties, we see a lot of people doing the wireless bundles, the TV bundles, the internet bundles. They charge for that. Pet fees, late fees over late fees, pet removal fees, trash removal fees, car parking fees. Is that just something you can do naturally, or do you have to provide something in order to be able to push those numbers?
We do renters insurance. We do all those things. We try to make as much money as we possibly can. You do have to deliver value, you know, and so I think, you know, everything you just mentioned, it's essentially how can we go and scale and buy and then offer maybe a better deal to the resident, you know. So they are getting value for it. It's a profit center for us. But yeah, you definitely have to you know, deliver value for what you're doing. And I think the best way to push revenue is we all use, you know, rent software that, you know, tells us when to raise rents and how much we can. But I think it's really having people that understand the markets, they understand, you know, how far they can push and how tight the market is, you know.
Joe, what about with you?
Well, I think everyone's, you know, hit the nail on the head largely. I think at the end of the day, I mean, like to think we have great technology. We really work with training our teams. We really work on a lot of cutting edge data. And certainly we want to deliver, as Pat's talking about, the latest and greatest amenities where we can sell somebody bulk Wi-Fi at a discount to what they'd pay retail, but we're still making a spread. Same thing with rent insurance and all of those other layers. But at the end of the day, you know, I've been in this business over 30 years, and I've yet to see Mrs. Smith come into the office and say, you know, I've had really great service this year. I really like the amenities. Can I pay you more next year? That still hasn't happened. So the bottom line is you really have to deliver amazing customer service. And people will always object, whether it's $20 or $200. They never take it smoothly, but they recognize the value that you've delivered. If your customer service has been great, if your personnel have been friendly, literally, if you've taken care of their maintenance requests, and if there's some, you know, compatibility, if you will. So we work very hard, as Pat said. We want to keep our people happy. We want to pay them really well. We want to pay them based on KPI metrics that involve customer satisfaction. And the other thing we do, you know, we've got about 50,000 people living in our 35,000 apartments, which is smaller than a couple of these guys, but still a lot of great data points that you can get through surveying the people. And we like to stay in touch with them and be responsive to that and let them know they're being listened to. And all of those things go into the mix that enables us to get the rent increases.
That's fantastic intel for anyone that's starting out in the business, anyone that's building a platform. Just give services. So you besides owning the bricks and mortar, you're really in the service business as well, Laurent. Would you say you're a service provider? You're providing a service to your tenants, to your tenant base. And if you provide a bad service, it's going to affect you to be able to push rents. So the better the service, the more money you'll make, because they won't fight that hard against that rental increase. Would you agree with that statement?
Yeah, 1,000%. 1,000%. No, the only thing I would add compared to everything that's just been said on this topic is that what we try to do, and I think it's very important for the property managers to do to provide the best service, is to really feel they're part of a mission. They're part of something bigger. And so we make an effort to really integrate everybody from the property management company into the mothership, if you will, and they know exactly what's going on. They know when we are buying something in this market. The team in Virginia will be, you know, rooting for the team in Mississippi or vice versa. And they love it, and I love it. I love sharing all of this that we're doing nationally with each of these people, and it makes them feel stronger. Like I said, part of a bigger mission, and I think they do a better job.
I've got one final question. I think all of this has been incredibly helpful on a business sense. I was always brought up that if you don't give, you don't get. That if you don't share the great gifts that you've been given, it's very hard to rise up. And I think what would be very inspiring for everyone here is you guys have all been blessed, thank God, with great success. What have you done to give back to fellow man? What have you done? This is not a business question, this is an inspiration question. What have you done to help those less fortunate? What are you doing within your community to give back what you've been given? And I think if you can all spend just 2 minutes talking a little bit about something nice, something inspiring, I think that would be a wonderful way to close this out.
Well, I'm going to make this pretty concise, Henry. First of all, I think that for many of us, we understand that whatever we have came from the one above, and so it's our obligation to do what we think that you would want with it, and so we feel compelled to give back our financial resources. But I also want to add one other thing too. All of us were young at one point too, and I'm probably
Patrick still is.
Probably speaking for all of us, but I could tell you I spend a lot of time with not only the younger people that work within Harbor Group, but also I've talked to a number of people here, and I think it's part of our responsibility to help the next generation learn the business, learn what to do, what not to do, like we've done today.
I love that. Thank you, Jordan. Jeffrey?
So Tikkun Olam is important both at a personal and a business level. So on a business level, we're big on volunteer days and making sure that we as an organization give back. And quite frankly, also, we're in the housing business. And so during COVID, we had a strict rule. We weren't kicking anybody out, right? We're working with every tenant to make sure that there wasn't somebody in need. Now, by the way, we differentiate between someone who communicates with us and is telling us what's going on and that they need help versus what we call a tenant who clearly is trying to game the system, right? And then on a personal side, I still have little kids at home, and so I'm trying to be that role model. And so I personally, my wife and I, break it up into three. One is Israel, one is in the United States, education, and food insecurity. And so in Israel, it's, there's a fraternity brother. I went to the University of Pennsylvania, and it's a guy who actually went to Wharton and became a rabbi. And so, the whole fraternity continues to support this little UJA, this little, mission in Israel. So that's become near and dear to me. Education is huge, as you guys know. If you don't, pre-K programs, the reason that people talk about it is because if you don't, teach a little kid to read before he gets into kindergarten, the chances are that there's a higher probability they go to jail or they don't finish school, et cetera, et cetera. So my wife and I are hugely involved in, pre-K educational programs, food insecurity programs. And then the last is there's a garden in Boca, which is where I live. It's called the Ability Garden, and it's for individuals who are handicapped both mentally and physically. And we teach them how to garden, from planting to harvesting, and now cooking, and now they're getting jobs elsewhere.
Beautiful. So. Pat?
Real quick, what Jordan said about meeting with young guys and giving back. I don't know if you remember, but at the J.P. Morgan conference, I was one of those young guys, and I was picking your brain. I'm sure I know I picked your brain, and your brain, and your brain. So, and yeah, but it really is, and it's hard it takes time, it takes effort to meet with people, and have them ask you frankly stupid questions sometimes, and but that's really how I learned the business. So I spend a good amount of time doing that as well. I think it's huge, and I just feel extremely fortunate. These guys all belong up here. I got lucky, and so
such thing as luck.
I give to 250 charities, annually. One of the big things I did was my high school I went to. I've helped them kind of rebuild their campus. And really, I focus on in the Boys and Girls Club. I grew up playing basketball at the Boys and Girls Club in Tampa Bay. I'm on the board there, and I meet with and kind of talk about entrepreneurship and things like that. But you know, there's not many charities I say no to, but you know, things that are centered around the youth, right? Like 10 years from now, if we're not involved in helping the youth, we're all going to be screwed. So it's a good investment as well, But yeah, happy to give back.
Lovely. Joe?
So I agree with everybody. I mean, it's all about giving back at the end of the day. God promises us, give and ye shall receive, and I've always felt it's important to give till it hurts, and when you give till it hurts, it's always come back tenfold. Like Jeff, we kind of work on a corporate level and on a personal level. On a personal level, my wife and I also kind of divide things into three. About a third is primarily devoted to fighting anti-Semitism on college campuses today, which we think is very important, and we're growing Chabad and Hillel at about 15 different college campuses. We're also working very hard on scholarships for primarily minority entrepreneurs to grow, and we're doing that both personally and professionally. We think that the real estate world and the business world needs to give proper access to minority men and women who maybe haven't had the same access, and we need to give them the tools and the access, and there's no question they can achieve, much like, frankly, the Jewish community did 100 years ago. And I know there's at least a couple Jews in the room today that I'm speaking to, and so we all know where that is. And then our third area of emphasis personally is on diseases, heart disease and diabetes and the like, and we try to support them. In the corporate world, we sort of mimic that to some extent in that we're also very actively involved in recruiting, training, and scholarships at the historically black colleges and universities. Again, we think that that's a great opportunity to tap talent. And we think that not only is diversity good socially, but we think it's good business. We think that the more reflective our company is of our consumer and our customer and our residents, the better insight we'll have and the more great ideas and new eyes that we'll have on businesses. And similarly, the company runs actively with a group that is focused primarily on minority single moms, to give them entrepreneurial courses, and we've partnered with a group, I'm not sure if I love the name, but called Millionaire Mastermind Academy, and we've now opened 3 ongoing semester classrooms that are both virtual and real. We've graduated over 1,000 women in Atlanta, Phoenix, and now we've expanded that to Tampa. And there we also provide scholarships for those who come out of these entrepreneurial programs with the best business plan to try and give them, again, the access and the tools to become self-supporting.
Laurent, you're the last.
Okay, very quickly, I will just say this. I have to give credit to the people that I've been working with for 14 years and have shown me the way when it comes to philanthropy, and I'm talking about the Kushner family. They're among the most generous people I've ever met in my life, and today I'm able to give, my wife and I are able to give, and it's really thanks to them and following their leadership, so I wanted to acknowledge that. Number 2, I think that it doesn't take a lot of time to help, and sometimes you just need to put your mind to it. I'll give you one example. I do a lot of different things, but one that I just heard you talk about COVID. It reminded me, I forgot about it, but a year and a half ago, COVID started, and I knew that some people in the neighborhood couldn't get delivered meals because they were in quarantine. So a friend and I said, hey, why don't we order food from this restaurant? It will help the restaurant, and start having them deliver the food to those people. And 2 of us, me and my friend, from our respective living rooms without leaving our apartments, before you know it, we raised a few dollars and we arranged 15,000 meals. Wow. And that were all distributed to people in New York City and hospitals. And it was fantastic. And honestly, it sounds big like this, but I'm telling you, it didn't take that much time. So, anyway.
I want to take a moment to acknowledge and thank all of you fine gentlemen for coming up here and spending some time with us. Big round of applause. Thank you very much, Jordan, Jeffrey, Patrick, Joe,
Thank you, Henry.
Laurent.
Thank you.
Really a fantastic panel. Enjoy lunch.